Bank of America Institute is out with its consumer checkpoint for October. Debit and credit card spending increased by 2% year over year. That was actually the largest increase since December of 2024. Gains were up on a month-over-month basis as well. And joining us right now for a closer look is Liz Everett Krisberg. She is the head of Bank of America Institute. Liz, this is really interesting because just this week we got NRF data that suggested the consumer actually slowed down in September. Your data is counter to that. Explain what you saw in your data and why you think the difference.
Sure. So what our data showed was that the consumer spending is continuing steadily upward, both on a year-over-year and a month-over-month basis, as you said. But what drove that was services and gas. Retail spending was actually down just 0.2%. But you did see a difference there between what we were seeing in services, which continue to grow. Gas obviously was up, and then retail came down.
So I don't know the NRF data well enough to know if it includes services and or gas. Is gasoline part of that? Because some retailers like a Costco and a Sam's Club actually sell gasoline. They strip it out separately.
I think so. The way that we look at it is we look at retail X gas, services X gas, X restaurants. But what I think is also really important about the way that we look at it is we are not taking a survey asking people what they're doing. We're actually looking at, as you know, almost 70 million consumers and showing what they are actually doing in a close to real-time basis. What really stuck out to me, though, was that while spending was continuing to move stronger, right, there was really a bifurcation in terms of the spending between higher income and lower income households. Now, all of the income groups did increase their spending, but the difference was fairly significant. So lower income households increased their spending by 0.6. Now, that's up from when they were flat in the middle of the summer. But higher income household spending growth increased by 2.6%, right? So that's more than 4 times higher than what you were seeing. So there's also a difference in terms of the kind of a tale of two cities in terms of what's driving that spending growth and what they're spending on.
How does your demographic break down? If you're looking at 70 million homes, is it a fair reflection of the overall American economy, just in terms of how much on the low end, how much on the high end?
I think, listen, by definition, we don't capture all of America. We've got a geographic bias in terms of where we are, but we are very, very broad. I mean, by definition, we're not going to cover the unbanked, for example.
Right.
But again, I think when you look at the total size of what we're looking at, it is still very representative.
One thing you did find is that there is data suggesting slowing employment growth.
Yes.
What is that?
So one of the things, we don't just look at spending data, as you know, we look kind of across the board. And what our data is showing is that the labor market is fatigued. We're seeing signs of a slowdown. One of the things we look at is the number of, kind of an estimate of the payrolls report, is the number of households who are receiving paychecks. And what we saw in September was that number increased by just 0.5%. Now, it is still growing, but only by 0.5%. Compare that to the beginning of the year, it was up 1.7%. Compared to 2 years ago, it was close to 4%. So we are seeing signs that the labor market is fatigued, that it's slowing down. But we also saw that for those households that are employed, their wages are growing. Now, again, we're seeing a difference between higher income and lower income. So higher income household wage growth was up 4% in September. That is the biggest number in 4 years. And it's the 5th month in a row that higher income wage growth has been accelerating. Lower income wage growth also ticked up, but 1.4%. That's closer to the lower level kind of over the last, really since the pandemic. And that, I think, really helps explain.
That's not keeping track with inflation.
Well, yeah. I also think that really explains that wage growth is part of what explains the bifurcation in the spending, right? If your wages are growing up, you're going to be more comfortable spending more. Now, the other thing to think about here is for the higher income, which is really driving the spending growth, right, is they're also being supported by wealth effects. Right. They're also being supported. If you look at the
stock market at new highs.
Stock market at new
Crypto
highs.
High.
Certainly housing, right? They benefit more from housing. And that is supporting the spending. And what we see in particular is it's supporting higher income discretionary spending. So discretionary spending really does track what the market's doing. The market's doing what it has. That's one of the things that's supporting the higher.
I mean, I think this data is more important in a time where we might not be getting some of these numbers from the government. We've already missed the jobs report. What would you have guessed the jobs report would show us based on what you've seen?
Well, what we, as I mentioned, what we saw in our data and our estimate of kind of payrolls was that in September it was up 0.5%, but that's much slower. We don't project what the exact number would have been. But I do think the story that it's telling, and this is why what we are looking at, I think, is important, is that the labor market continuing to grow, but certainly at a more fatigued and a slower pace. Mm-hmm. But the consumer, the broad consumer, driven by the higher income consumer, is still out there spending.